Hi, I'm Paul Carroll. I'm the editor-in-chief at Insurance Thought Leadership. I have the honor of being joined here today by Ken Mungan, who is the chairman of Milliman. He recently moderated a panel that I found very interesting at the International Insurance Society's Global Insurance Forum. I found it so interesting, I still have the background up behind me. And I thought we would explore that some today. The topic was how to narrow the protection gap through innovation. And the protection gap is obviously one of those things that's been around for a long time that people have talked about. That's a clear problem. It's something where if we can narrow it, we can not only do good things for the industry, but for the public and for clients. So it's just one of those things that never seems to quite get solved, but always is worth attacking. And innovation is something I've focused on for a long time. Ken has much more successfully than I have. He's in his position partly because he started a line of business for Milliman that has done so well over the last 25 years or so. So with that as prelude, Ken, I thought maybe I'd start out just by asking you for some general thoughts on the protection gap and how we finally make progress against it through innovation.
Thank you very much for having me here today, Paul. And you're absolutely right. The protection gap has been this kind of persistent issue that people have, and there's a lot of potential to reduce it through innovation, but it's been an amazingly challenging problem. But the good news is I think we're actually making progress. There's incremental progress in so many different areas. It's finally starting to show a cumulative effect. And so looking at it at the highest level, people can benefit tremendously from pooling of risk. I think that, there's an old saying that there's no free lunch in economics except diversification. And a great example of that is just pooling of risk. You have an individual who's exposed to all these discrete events that could be absolutely devastating to them, but by accessing some sort of risk pooling mechanism through an insurance company, through whatever the mechanism is, they're able to transform that risk and offload it and get kind of the average experience of the group, if you will. But when you look at actually delivering that to somebody, there's the mathematical benefit of risk pooling, but then there's all the costs of manufacturing. It's just like any other industry where you're manufacturing a product and you have your factory and you have all of your input costs and then your sales and distribution costs and your marketing costs and so on. So all of those costs add up. Excuse me. And when you get to a certain level, it starts to degrade the effectiveness of the offering for people, and they start to lose interest in that kind of value of being protected. And we've seen in industry after industry that technology can be used to drive costs down. And now we're seeing that come in a big way to the insurance industry, whether it's the cost of actually connecting with a customer in the first place, the cost of completing the administrative process of doing a transaction, maintaining the contact with that person throughout their time being protected, and then for the people who have that adverse event, what's the cost of actually paying the money to help them restore them to a positive situation. So all of those costs can be driven down with technology, and I'm seeing that happen all throughout the insurance industry. I think one of the key things with protecting people, though, is there's no way that you're just going to simply drop in some module of technology to reduce costs, and that by itself is going to solve the problem. Because ultimately, protecting people is about trust. People have to trust that if the bad event happens, that whoever they're working with, the insurance company, however they identify that group, that they're going to be there for them, that they're going to deliver at that difficult moment, whether it's to do with life insurance, retirement security, health insurance, insurance for a commercial entity or an organization. So I think where we're seeing really the most amazing results is where technology is being used to leverage personal relationships. So instead of one person able to access maybe 40 or 50 people, now they can access 500 or 1,000 people, and then that. So it's that combination of reducing costs and actually magnifying the ability of people to form meaningful connections and trust one another. That's really transforming the industry.
That makes sense. I tell people I've been watching the same movie for 35 years now, because I go back to covering the computer industry for the Wall Street Journal all the way back in 1986, and some of these things have played out, and that ability to reach masses of people in a individual way, I think, is powerful. One of the things that's always struck me is that people talk about how insurance sells peace of mind, as well as the actual payment, the restoration that people get after a problem happens. And it seemed to me that the cost of that is basically the 40 cents or so that of each dollar that becomes overhead or profit. 60 cents or so goes out in claims, and the rest is basically the cost of the peace of mind. But if we become much more efficient, and it becomes 30 cents of every dollar, 35 cents, 25 cents, whatever the right number is, then that's basically lowering the cost of the peace of mind product. And it seems to me that as the industry gets more efficient, and I certainly think it can, then the protection gap just sort of narrows because the cost drops. That's a long way of saying it, but I'm basically asking if you agree with my thesis on that.
I do, and I've seen it happen. The insurance industry is a very competitive industry. You have a lot of insurance companies competing with one another, and ultimately the cost of manufacturing the product is going to be that claim cost, all the different costs that they incur, sort of interacting with the customer, finding them, servicing them, and then there's capital. They have to set aside money for the mathematical variability that you have anytime you offer people protection against an adverse event. There will always be uncertainty as to how many disasters will there be in a year, what will mortality be, and so on. And so that cost of capital is there's a competitive market for that. And so you don't see insurance companies just able to dramatically increase the returns that they're going to get and just keep all that savings for themselves. It very quickly in a competitive market gets passed through to the customer in terms of extra benefits and better value for the customer. And so I've seen that process work very clearly throughout the industry.
So that I'm glad you didn't tell me I was full of it. One of the things that I found most intriguing on the panel you did was Lorenzo Chan's statements about the work he's doing at Pioneer in the Philippines, where they, as he put it, had gone down the pyramid and were really getting into the micro insurance market, and we're even to the point of going through pawn shops and supermarkets and motorcycle dealers, because that was the place where they could touch customers in ways that the customers trusted, and could do this sort of mass scale individual connection that you're talking about. I guess I'd ask you to maybe say a little bit more about that if you were as struck as I was. And then beyond that, just talk about other examples you've seen in your travels that you think are really good, innovative examples of people narrowing the protection gap.
Yeah, I think you hit the nail right on the head. Look, Lorenzo Chan is one of the great innovators of the insurance industry in terms of the work that he and his colleagues at Pioneer are doing in the Philippines. And it's just inspiring to see the success that they're having, but it's no fluke. I think on a number of levels. So first, at the most basic level, I think there's finally been a realization that risk management, insurance protection is actually a requirement for development. If you go back 15, 20 years and look at the countries that were sort of on a path to developing to become ultimately part of the global middle class, the idea was that what they really needed was an effective system for credit, finance, banking. If people can borrow money and start a business, then that will sort of help the society bootstrap its way up the economic ladder and develop. And then later on, after they've developed, you'll get things like insurance and risk management, that those are consequences of development. Clearly now people realize that wasn't right, that risk management is actually necessary for development, not a consequence of it. And that when you give people especially people who are on that first, second rung of the economic ladder, simple, clear, effective tools to protect themselves from risk, extraordinary things happen. They're able to climb up that ladder. And if they don't have it, then the results are really negative. If you think about sort of a middle income person in the developed world, let's say they're on the 12th rung of the economic ladder. If something bad happens to them, maybe they get knocked down to 11 or 10, but ultimately they'll be okay. There are so many support mechanisms spread throughout that society that they'll find a way to keep on with what they need to do in life. But if you're on that first rung and you have an adverse event, you are knocked off that ladder and the results are absolutely catastrophic. So what Lorenzo and his colleagues in the Philippines have done is they've seen that people, when you can drive the cost down and explain these products to people in simple terms that they can really understand, they understand the benefit to them. It resonates with them on an incredibly visceral level. And it gets back to that combination of technology and relationships, that you got to look at, well, what economic transactions are people on those early rungs of the economic ladder actually engaged in, and go where they are, connect with them through people that they trust, use technology to drive the cost down to a lower level, and then let the system develop. It's because people are going to be very active in protecting themselves. I think the other thing is on the flip side. So if you connect to people through affinity groups, he mentioned motorcycle shops, pawn shops. We've also seen that a lot of people throughout countries like the Philippines, their kids go to private school and the parents have to pay school fees. So the group of parents who are trying to make sure that they can actually pay for their kids to go to school, whether it's small scale farmers and through the supplier that they're buying their seed from. You can find all these groups where people kind of organize, they have an affinity, and they're trying to complete a transaction where it's actually in both parties' interests for that person on the early rungs of the economic ladder to be protected. And so, because it's, if people are able to continue making steady progress, even in the face of adverse events, they're better customers, they grow economically, they're able to engage in larger, more significant transactions. And so it's actually not just a one-sided transaction. It's actually in both sides' interest to make this happen. We've seen this in small scale farming, where if it's a cash crop, whoever they're selling to, that entity might be a large global company, but they want to have a high reliability of supply. And their reliability increases if those small scale farmers are protected against a storm, against a drought, against some type of adverse event. And so we're really seeing that type of success that pioneers had in the Philippines really start to take off in lots of countries around the world. On the Milliman side, we have the micro insurance center at Milliman, and so we got great visibility into that, and it's been pretty exciting to see these success stories.
It's interesting. If you were thinking from the Milliman standpoint, or just maybe more broadly, what would you see as the starting point for somebody who's trying to innovate? Would they be looking for that distribution channel? Would be looking at a technology? Would they be looking at a product? Or how would you suggest somebody get started on the innovation journey?
I think there's a few key points. First, you've got to have distribution. So what's the strategy? And the distribution process has to make sense. If you can piggyback on ways that people are coming together where they have a common interest, then that's so much more cost effective than sending a person out, one by one to lots of random people. They're kind of old style, model. It just has a higher cost to it. Like in Lorenzo's example, he was talking about giving people $300 after a disaster struck. If the claim size is $300, that distribution cost has got to be small. And so you look at for groups of people where the distribution costs can be low, and then how can you use technology in a way that's actually makes sense in that country at that stage of economic development. You don't design something for the latest Apple smartphone if people have very basic phones. But then the basic phones, you can do all kinds of cool things that that couldn't be done 10, 20 years ago. And then I think you got to answer some fundamental questions like why will these people trust the offering? And that's so critical, because if it comes across as complicated, if it doesn't have that kind of high degree of trust and reliability, then it's just not going to turn into sales.
I've always been struck as well at how creative people can be when you give them the chance. I mean, for 15 years or so now, there's a system of basically banking that's developed in Africa, based in Kenya, where people basically pay with cell phone minutes. So as you said, they didn't build the whole infrastructure, but I have minutes, I can send them to you, they're valuable to you, that becomes a sort of currency.
Right. And just on that, we're seeing just exponential growth of electronic money in Africa. In particular, M-Pesa is a really interesting example. I mean, we could see that have 200, 300 million people on it, in the very near term, and that type of development gives the developing world a way to leapfrog the developed world, because if you can make things all electronic without somebody having to go around and collect very small amounts of cash, that cost of manufacturing the insurance just dropped tremendously. And I think that's really sort of the next wave that's already underway.
I agree, and we could talk about that for a long time, but I realize I've sort of eaten up the time I had requested on your schedule. Are there any final points you'd like to make about innovation or the protection gap, or anything else before I let you go?
Well, I mean, my view is that people have three fundamental needs. They need to be loved, they need to be part of something larger than themselves, and they need to be protected. Everyone needs to be protected in so many different ways. Protecting your house, your family's financial security, your health. Companies and organizations need to protect themselves so that their people can do the amazing work that they're doing. So it's not like we're trying to get people to do something that a lot of them might not actually want. It's like, this is something that's fundamental to human life, and so it's exciting to see these barriers that have been preventing people from realizing this finally being sort of swept away through advances in technology and better understanding of how people can actually form those relationships of trust that are critical to getting this done. So it's a pretty exciting time.
And I'm delighted to hear you say that you're seeing progress on the protection gap, because that's about the biggest thing I think the insurance industry can tackle.
Absolutely.
So, thanks, Ken.
Well, thank you very much, Paul.